In this module, we're going to understand retail banking risks and the difference between retail credit risk and corporate credit risk in very simple terms. Retail banking mainly involves taking deposits from customers and giving loans to individuals and small businesses. These loans include mortgages, home equity loans, car loans, personal loans, and small business loans. Each individual loan is usually small, but together they form a very large portfolio for the bank. The biggest risk in retail banking is credit risk. Credit risk means the risk that a borrower fails to repay the loan. If many borrowers default, the bank suffers losses. A good example is the 2007-2008 financial crisis. During that period, banks gave loans to customers with weak credit quality and very high loan-to-value ratios. Loan-to-value ratio means the loan amount divided by the property value. When house prices fell, many properties were worth less than the mortgage amount. Borrowers stopped paying and banks faced huge losses. Although credit risk is the main risk in retail banking, several other risks also exist. Operational risk refers to losses caused by internal failures such as system errors, fraud, or poor processes. Business or strategic risk arises when banks introduce new products or follow aggressive growth strategies that later turn out to be risky. Reputation risk occurs when customers or regulators lose trust in the bank, which can lead to loss of business and legal problems. Interest rate risk happens when changes in market interest rates affect the bank's profits, especially if loans and deposits react differently to rate changes. Asset valuation risk arises when the value of collateral, like houses or cars, falls, reducing the bank's recovery if a borrower defaults. Now let's understand the difference between retail credit risk and corporate credit risk. Retail credit risk involves many small loans given to individuals. Because there are many borrowers, the portfolio is highly diversified. If one borrower defaults, the impact is small. Losses are more predictable and can be treated as a normal cost of doing business. On the other hand, corporate credit risk involves large loans to a few companies. If one large company defaults, the impact on the bank can be significant. Corporate portfolios are less diversified and more concentrated. Losses can be sudden and may exceed expectations, sometimes even affecting the broader economy. Retail portfolios also provide earlier warning signals, such as rising missed payments or changes in customer behavior. Banks can react by tightening lending standards or increasing rates for riskier borrowers. In corporate lending, problems may remain hidden for longer, and once they appear, it may be too late to take corrective action. To summarize, retail credit risk is diversified, more predictable, and involves many small borrowers. Corporate credit risk is concentrated, less predictable, and involves larger exposures. Understanding these differences is very important for managing risk effectively in banking.